And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Good morning and welcome to The Real Investment Show. I'm your host, Lance Roberts, and today is another Real Investment Show interview series, and today's special guest is Vinay Gupta. He has worked with clients around the world, is formerly the business design and project lead at IDEO, and has previously held senior positions at media, telecommunications, internet, travel, and venture capital companies. From 2009 to 2013, he founded and led Whipcar, which is the world's first peer-to-peer car rental marketplace. And Vinay has earned an MBA from the London Business School, has a double degree in behavioral science and finance from the University of Maryland. Won't hold that against him. Contributes to the innovation curriculum at LBS, London Business School, and currently serves as an advisor to several early-stage startups. Vinay, welcome to the show today. How are you?
Hey Lance, how you doing? Thanks so much for having me. It's a real pleasure to be with you. Thanks.
Perfect. Yeah. So I wanted to spend a bit of time. So our show that we do, we talk to a lot of older investors, people that have money invested in markets. Little bit, we tend to skew a little bit older in our demographic towards, kind of early retirement age to retirement age individuals. We do have younger investors that also watch the show, but again, kind of our demographic skews a little bit older, probably because I'm 950 years old myself. But I wanted to spend a little bit of time today with you to discuss cryptocurrency, Bitcoin. It's obviously become a much more mainstream product over the last few years. There's lots of information out there, videos and commentary and experts all running around, with their point of view. And I want to spend a little time today just, kind of starting from the basics and going through the investment risk of cryptocurrency. What it is, what should we do with it as investors, and how should we be thinking about it as an asset class? And so kind of starting out, just can we just start out, kind of setting the stage here? Bitcoin's been around for more than a decade, but there's still a lot of confusion about what it actually is. There's a lot of expectations from one group of people it's going to replace the dollar as the global reserve currency. Why do you think that Bitcoin and cryptocurrencies have captured so much of investor attention over the last couple of years in particular?
So again, great to be here, and thanks for inviting me to this forum. Before I answer your question, for hopefully the benefit of the audience, a very quick history of myself is that I grew up learning TradFi, which is a short nomenclature for traditional finance. So I have a finance degree from a U.S. institution, and then I worked in corporate finance in a number of functions early in my career before I moved abroad and ultimately did my MBA and worked in a few other areas. So I say this only because I wouldn't say that I'm a quote unquote crypto native person. There are literally very intelligent and maybe some less intelligent people that don't understand finance from any kind of traditional perspective. So their first foray into this world of finance is through cryptocurrency. So I think this is a helpful frame for people to understand, to understand where someone comes from, because it helps you understand how they think about financial rails. So with that preamble out of the way, I think I'll give you a short answer, and then you can ask me another question. Why this has captivated the attention of, I guess, society for the last almost 15 years is that this is a new invention of how to transfer value between humans. And because of that, and because, Bitcoin, for example, doesn't have a CEO or, a management team, it's captivated our audience. Why are people, trusting this to transfer value?
Well, that's right. And I guess, this is, kind of two things. One is that it's captured a lot of attention because it's gone up so much in price. So again, we have the just the speculative investor side of this. That's, oh my gosh, it just keeps going up. It's gone from basically a dollar to $100,000, and we hear lots of stories about the individuals that were early stage investors in Bitcoin, and now they're multimillionaires, and it's been fantastic. So that alone gets a lot of attention, but there's also this conversation about what it's going to be in the future. And there was a lot of hope a few years ago that within the next decade, which we're now kind of, later into, is that a lot of daily business would be done through the blockchain. And the Bitcoin was kind of the offshoot of the underlying technology, which was the blockchain, which would allow us to, for instance, we could transact a real estate purchase and sale without actually having an intermediary in between, because the transaction could be verified. It could be executed between two individuals, and it was all going to be very simple. Yet we haven't really seen any, kind of large use of blockchain technology so far. And, it's still one of the beliefs that that's going to occur, but it just hasn't happened yet. I mean, I still today, I can't go down and buy Starbucks coffee using my cryptocurrency, right? Tesla endeavored into it temporarily. They allowed to take Bitcoin for a while to buy a Tesla, but it was so volatile that they had to stop doing that. Do you think at some point that we're going to start to see the evolution of blockchain into what it was expected to be, and that would certainly enhance the value of the underlying currency itself, right?
Yeah, so there's a lot there, and you bring up very, many interesting points that I'd love to dive into, based on your desire. So let me tackle a few, and then we can dive in. So one, I would encourage you and your audience to think, to not make the, forgive me for saying so, the mistake that the benefit here is some sort of like blockchain technology, and then things sit on top of a blockchain, whether it's Bitcoin or something else. While that may not necessarily be untrue, think of it rather from accounting perspective, right? And the blockchain in this case, quite rightly, is a series of ledgers, literally books with graph paper, that record all the transactions that are made. And so any business, regardless of whatever industry, can have ledgers, and those ledgers, hopefully work, pay people on time, pay suppliers on time, etc. So actually, what matters is, what is the robustness of those ledgers? Are they recording the transactions properly? Are people getting paid on time? Are they not getting paid on time? If they are, then that blockchain is serving a purpose, right? And then the price, to your point, is what is driving the daily flows back and forth, settling value. That's sort of the above the line of what people see. So it is important to not conflate blockchain being like the important thing, and then whatever comes after just being how it's using blockchain.
So let's dig into that a little bit more, because again, there seems to be kind of two things. So this is my view, right? I see two things going on here. I see the blockchain, I see the value of the blockchain and what it can mean. But yet, as I said, we don't really have any large scale use of the blockchain technology that I'm aware of. Maybe it exists on some smaller scales, but again, we're not executing real estate transactions nationwide using the blockchain. We're not buying and selling automobiles using the blockchain. We're still using traditional banking methods for all that. And then we have the cryptocurrency side, which has taken on its own life of investment, right? So it's just become an investment vehicle. So and again, you said it's important not to conflate these two issues, but how do these work together in theory?
Fantastic question. So I'll give you a two-part answer. One, I acknowledge and accept and also agree that it doesn't necessarily make sense to have some sort of blockchain that's going to arbitrate our real estate transactions or our automobile transactions. One, and not limited to, main reason why that wouldn't make sense is that there is to use industry nomenclature, an attack vector for both of those examples, because there's an actual, a lot where the car resides before you pick it up, or the house is, subject not only to property tax, but a tree could fall in it and destroy it, or you need to pick up the keys to get into the house. So these aren't relationships or interactions that can be purely facilitated through digital means. Now, you switch to something like transferring money without an intermediary. Before something like Bitcoin, this is impossible, and it still remains impossible today based on the traditional dollar system, right? When I pay you retailer via my credit card, you actually don't get that money right away, right? It doesn't even hit the ledgers of Visa until midnight that night, and then depending on how active of a merchant you are, you might get paid in a couple of days, or maybe it could be a week, and maybe the best people get paid overnight, but still, you're not getting that right away, and that's because there's intermediation between that transaction.
So flesh that out a little bit more for me, because so great. There's this intermediation. I've got this transaction to complete, but I'm trying to figure out, where this eventually winds up. Because here's where this is where I struggle with this conversation. So if we're only talking about Bitcoin, just Bitcoin itself, okay, great. We've got the blockchain. We have a singular, cryptocurrency, Bitcoin, fantastic. I can see building a system that works around that. So everybody's accepting the same cryptocurrency, everybody's accepting the same transaction, and we're doing this on a blockchain basis. That makes sense. However, we don't have that. What we have is we have the blockchain technology, and then we have 5,000 different currencies, right? From, Doge to Fartcoin to you name it, right? So there's just, everybody just creates a new currency, and it's not for any real blockchain technology use. It's not really for any type of economic transaction. It's simply for making money. It's simply they're creating the coin, they're issuing it, they're hoping people will buy it, they make the spread on the transactions, and they make money, and hopefully the investor makes money. Sometimes they do, sometimes they don't. That seems to be a bug in a bug in the system, not a feature.
Yeah, again, great framing of your question, and I think a good setup. So what I would say, again, with the privilege of being able to address your audience, is to encourage your audience to actually see it in a kind of bipartisan world. So there is Bitcoin, which is a cryptocurrency by definition. But then there is all other non-Bitcoin crypto, which is not to diminish it in any way or even diminish the value of it. But it's important to think of it in a separate way, because I'm not going to be able to do a instant tagline of saying why it's different or better. This takes self-study and introspection. But the point is, Bitcoin is different. It's about 60% of the cryptocurrency market. So for that reason alone, it deserves, its own way of thinking about it. And then there's, let's say, everything else. Out of the everything else bucket, I would also encourage your audience to think about the everything else bucket as stable coins. And stable coins, specifically US denominated stable coin, is an important thing and a bridge between traditional finance and the future, and then everything else. So we're now talking about Bitcoin, stable coin, and then everything else. And again, everything else is not to diminish that. It's just that those things can have different use cases. And to use something like Dogecoin, which is easy to make fun of because it was actually invented as a joke, and no one who even invented it thinks it's serious. But the mere fact that it still encapsulates about, I think, $25 billion of value, market cap, it means it does have value, right? Going back to market price.
Right. So now you've introduced kind of where I was going to on the next topic, because here's the problem that I see currently that needs to get resolved. Let's say, for instance, I'm a manufacturer, and I live in France, and I live in France, and I'm manufacturing French champagne. Okay. And I want to use cryptocurrency to sell my product to consumers in the US. Well, I can execute the transaction today using cryptocurrency, but then I have to ship the product from the producer side to the distributor. From the distributor, it's got to eventually get to the end retail client, wherever that is. The problem has been, and we kind of saw this with Tesla as well when Tesla tried to do this, is that by the time that I potentially receive the product and get paid for it, there could be such a big swing in the price volatility of the cryptocurrency, I could wind up losing money, which really brings to the top the value of stable coins. And stable coins have a lot of value potentially in a lot of areas, particularly when stable coins are backed by US Treasuries, which, and as you said, they're a lot of these are dollar denominated, so they're backed by US Treasuries. But that stable coin, that structure, provides a much more advantageous way for companies to actually do business using cryptocurrencies. Is that a fair statement?
So without saying whether it's fair or not, because I don't think that anything you've said is wrong, let me just try to reframe a little bit. So one, with Bitcoin, again, audience, think about Bitcoin as a big B and a lowercase b. So the lowercase b is the thing that's, I don't know, 112,000 per coin right now. The big B is the network. And so this is something you need to think about, where it is a currency or a medium of exchange or a store of value. These are three different ways to describe money. It's all of those. And it also is transferred on its own network. It takes a while to figure that out, but that is something very unique. Even the US dollar does not like travel on its own network all the time. Mm-hmm. Again, something to think about. Going back to your point about the retailer or manufacturer in France sending, I guess payment or exchanging value and then shipping, a case of wine or what it might be. Rather than saying whether that's a good thing or a bad thing or introduce volatility, which we can, mm-hmm. and actually I will, what I would say is that money has different dimensions. One is as a medium of exchange. Okay. Another is as a unit of account. Money can be a collectible. People in the audience, myself included, have, unfortunately not very much, money saved up in some old baseball cards, right? It has value, but you're not going to go to the Starbucks and pay for your coffee with a baseball card. But if you go to the right place, you can get it.
Sure.
Similarly, you skip right to gold, and gold is something that is very valuable. I think, over $4,000 an ounce. But again, you don't pay for your coffee with that. So the crazy thing about Bitcoin is you can pay for your coffee with Bitcoin. It's not beneficial for you to do that based on US tax code, but you could. But you could also store it. And if you stored it for the last 10 years, you would basically go from close to zero to $112,000.
Sure. But for instance, using your gold analogy as an example, yes, I can buy something with gold, but I have to convert it into US dollars first. It's the same thing with Bitcoin. I can't, correct me if I'm wrong, but I can't, if I walk into a Starbucks right now, I can't say, I'm going to pay for my coffee with Bitcoin. I've got to convert it into dollars first, and then I can purchase for the coffee. I still have to make the conversion, right?
So I can tell you from real personal experience, okay. And I should pay you a commission for this setup. I have my own coffee, and I won't say the name unless you allow me to.
Go ahead. Go ahead. Tell people what your coffee brand is.
I have a coffee. Please check it out. I sell some of the most expensive beans in the world. orangepillcoffee.com. Thank you so much.
Sure.
And I accept payment in Bitcoin. And I would be thrilled if you paid me in Bitcoin. You actually will get a discount, 20% off. And when you send me the Bitcoin, I am not going to convert it. So there's a real example of not having to. And even your gold example, mm-hmm. If you were to pay me, $4,000 for something, I would be privileged to take your gold coin.
Sure. And again, that's you. And because you understand, kind of what the dynamics are here. But I'm talking about general transactions across the board. And this right. is, and again, this is all kind of getting me to kind of my point. So how, from your perspective, how do you view Bitcoin? Is it a currency? Is it a commodity? Or is it a speculative asset? And maybe, and you can talk about that from what is it today? What will it be in 5 years? And what do you think it'll be in 10 years?
Okay, cool. So speculative is always in relation to something else. So one could make a valid argument that the US dollar is speculative in relation to Bitcoin. I mean, I know that one Bitcoin in my private hardware wallet is going to be one Bitcoin, tomorrow. And I guarantee you that $1 today will not be worth $1 in real value 12 months from now. So, going back,
that's not necessarily true. Only from the standpoint. So think about it this way, right? So you just made the correct statement, which is you have $1 today sitting in your wallet, and a year from now it'll be worth 2% less because of inflation, right? So that's how you're depreciating the dollar, through inflation. But if you have one Bitcoin today, it might be worth $112,000 today, but it might be worth $100,000 a year from now. It's not necessarily going to go up. We're just assuming it's going to go up in value because it has gone up in value. But that's the speculative asset that we're talking about, which is we're speculating that it will be higher in price. But we know for a fact that $1 will buy $1's worth of goods today, and it'll buy $1's worth of goods a year from now. We know that will be the case. The quantity of the goods I may get in a year will be 2% less, which is why we need to invest our dollars. We shouldn't sit with our dollars in a coffee can because of inflation. We need an asset that will outpace inflation over time. But that could be stocks, it could be Bitcoin, it could be gold, it could be any asset, right? So that's always been a little bit of my struggle, is that, with talking about Bitcoin, is that everybody just assumes that Bitcoin will be higher. But we know for a fact that 50% corrections in Bitcoin have not been completely uncommon.
Yeah, I think that's a fantastic, characterization of like a real world, problem and sort of malaise around this area. And let me give you a tangible example, which I hope resonates. So let's say that we were coworkers, back in 1971 together, and for our study or whatever we did at university together, college together, we were both paid for $35 for our time to participate in that 2-hour session at college.
Okay. And
I accepted my payment with a 1 ounce gold coin, and you accepted your payment $35. Okay. Now
no. I want my payment in S&P 500 stock.
Okay, fair enough. In this case, and you know what, you could have taken your $35 and invested in S&P 500, and that would have been a great decision for you. But right. in my limited assumption set, the teacher gives you 35 and gives me the ounce.
Okay.
And because we made a friendly bet together, we decided to lock that up in a time capsule until this episode.
Right.
Today, you would take away your time capsule and you would, we'd exchange. You'd give me $35 and I'd give you an ounce of gold, which is worth over $4,000.
Sure.
So that's what I mean. That ounce of gold is the same ounce of gold. It's valued differently in US dollar terms, but the ounce is the same.
Right.
So that, I think it's a nuance.
Well, it is. But see, the difference was you invested your $35 in gold, and you stuck me with just $35 in cash in a coffee can, right? And so I didn't get to participate in inflation over time. And as the economy grows and as we become a larger economy, capitalism grows, you're gonna have higher prices. That's inflation, so that deflates the value of just $1 sitting around. But that's why it's so important we invest, right? And you wrote a great article recently talking about holistic finance and some other stuff, which is very important about investing our capital so that, I can take my $35 today in cash, but I need to do something with that to participate. And again, I can invest that into cryptocurrency. I can invest it into gold. I can invest it in stocks. A good example, if you and I, back in 1960, going along with your thesis, you took your 1 ounce, you took your $35 in gold. I took my $35, put in the S&P. Your rate of return since then was 3,000%. Mine was 7,500%. So I've more than doubled the rate of return on my $35 versus your gold and far outpaced inflation. So that's why, so to your point, it's very important that we invest our dollars and that we make those things grow at a rate faster than inflation over time. But I don't want to digress too far from our topic because I want to stay on point with what we're talking about, because we're talking about stable coins here, cryptocurrency, stable coins, and kind of all others in the basket, and how that potentially plays a role. One of the things that we're seeing a lot of, and kind of staying on the finance role for a sec, is I'm starting to see a lot more people talking about, get rid of the traditional 60-40 allocation model and let's just go to 60% stocks, 20, take the 40% bonds, and you have, 20% bonds, 10% gold, 10% Bitcoin. And, that sounds great until you get volatility. And, for investors that may have a limited time, that 40% that was supposed to be in the bond side of the portfolio, sure, it's not growing like gold right now. It's not growing like Bitcoin. That's that speculative fervor that's come into the markets. And so we all want what's going up the most right now. But the whole purpose of owning bonds in a portfolio is for stability, conservation of principal, and more importantly, protection of principal, because bonds always mature at face value and give you your money back plus your interest. Gold and Bitcoin doesn't do that.
I agree with you in terms of there is no perfect portfolio mix for every single person, so whether it be 60-40 or some other percentage, or if those percentages involve different asset classes, not limited to equities and bonds. I do encourage you, not you, but everyone, sure, anyone listening, that to abide by your own personal risk tolerance, right? And you brought up a great point in terms of what is the desired timeline of your investment objectives. Someone who is investing for 40 years into the future is going to have a different mix than someone who is investing 15 years out of the future. So what I would say as it pertains to this asset class of, let's call it cryptocurrency, is because it's an emerging asset class, it has asymmetric upside. So everyone, I believe, should have it in their portfolio, but some people may benefit from, a 2% or less allocation to their portfolio, whereas others, might be in double digits based on their own personal preferences.
Right. And well, again, personal preferences are going to come down to volatility. It's great as long as everything's going up in price. It's not. It really gets not very fun. And your behavioral science background will tell you how people respond during periods of stress. As long as markets are rising, it's easy to be invested. It's easy to take on risk. Markets make us look very smart when that's happening. The problem, of course, is that eventually you get reversions in all asset prices. Just as we're speaking today, gold's down 5% a day. Those types of reversions don't weigh on investor psychology. We spent a lot of time here on the show talking about behavioral problems that investors encounter that lead to poor returns over time. They buy high, they sell low, and that's all driven by that emotional kind of backdrop. So, volatility is a very important thing to consider when adding an asset class like Bitcoin or cryptocurrencies, whether it's Ethereum or whether it's Solana or Ripple, whatever it is. Full fair disclosure, I own all of those. But the volatility is something that it has to be worked into the portfolio so that you can sleep at night and you don't make those emotionally bad decisions. I agree with you, Vinay, that long term, I think cryptocurrency is going to be an emerging asset class that grows into a more widely adopted asset class. It will become, most likely at some point in the next 5 or 10 years, just a standard part of a portfolio. You've got your stocks, you've got your bonds, you've got your crypto, you've got whatever else in your portfolio. It'll just become a very standardized asset allocation that goes into portfolios. But that assumes that, again, you can withstand that risk. That's why when we're doing risk profile questionnaires for clients, we're saying, okay, well, how are you going to feel if you lose 10% of your value of your portfolio? Well, I can't do that. I'm too old. I don't have the time to get that back. But if you're 30, maybe no big deal, right? So I think, we have to really consider what that volatility risk is, because this is not a stable asset. When you're talking about raw cryptocurrency, again, it can be very, very volatile, much more volatile than the markets, and that can certainly weigh on outcomes. And that's why, I guess, we're having this conversation, from your view, how does that play from your view in a role of a diversified portfolio, and how would you approach that?
Yeah. So again, thanks for another thoughtful setup and question. Is one, I would say, just use a sports analogy, is that at some point Nolan Ryan was 10 years old or 14 years old, and he was very volatile as a baseball player. Some would argue he was volatile until the day he retired. And I'm sure that's right, actually. But the point,
he's also set records that will never be broken ever.
Absolute legend. I grew up, loving him.
He grew up in my hometown, so.
Exactly. So, but I think you can appreciate that for him and any other, young adolescent athlete, they are volatile. You never know if they're going to make it or not, right? Because of any number of reasons. That's the whole reason we have a whole scouting industry, and perhaps the NCAA itself is a scouting industry. But the point is that volatility is to be recognized and acknowledged, as you mentioned, and then you can't have 100% volatile portfolio. That is a wild thing. But now your mind has to shift to volatility. Don't conflate, whether it's gold, Bitcoin, US dollar, Apple stock with volatility. Two separate things. Right. One is the asset, one is volatility. Now, in terms of how it should factor into someone's personal mix, I would answer your question the following way. The world that we now live in with cryptocurrency, it is the first time in our lifetimes where financial product that exists, that is transferring real value, was not created by the financial industry. So it was a retail-led financial innovation that became institutionalized in January 2024 with the launch of the Bitcoin ETFs. Right. The reason that month is important is that it was that month when unofficially, company or career risk for existing financial advisors was mitigated substantially. It means that you could, with a straight face, look at your boss or look at your client and suggest allocation to cryptocurrency. And so the floodgates have now opened. It's been less than 2 years. And so I'd again encourage your audience to, obviously you put out so much great information out there, which I find to be very honest. I've reviewed it in advance of our meeting, to make your own decisions. Don't expect the answer to come from the incumbent financial industry, because you will get your news late.
Right. And let's talk a little bit about, let's shift to another focus here, because you wrote a really great article about MicroStrategy. I want to get to that in a second, so don't go there just yet. Let's talk about risk though for a second. There's a lot of, in any asset class, whether it's stocks. If I buy stocks, I've got concerns about bankruptcy risk, default risk, all other kinds of risk, operational risk, et cetera. If I buy bonds, I've got concerns about credit risk, inflation risk, interest rate risk, those type of things. Every asset class has risk. And, when you think about Bitcoin, we have to think also too about what are, the type of risk that I'm taking on. And in this case, think about regulatory risk, custody, security risk, particularly if you're housing, your own Bitcoin in your own cold wallet, or if you're using a platform like Coinbase to house your Bitcoin. Exchange risk, we obviously had, the whole issue with FTX, Mt. Go a while back. Market manipulation, liquidity risk. Those are the risks that we have to think about. So if I'm going to invest in Bitcoin, how is the best way for me to do it to where I can mitigate some of those risks? I understand that some of these risks I will never be able to mitigate. I mean, tomorrow, as an example, the Federal Reserve, the Treasury, the government could come out and say, you know what? We don't want Bitcoin and other cryptocurrencies floating around. There's a reason we can't print currency in our basements, right? It's called counterfeiting, and it undermines the central currency of the United States. That can only be printed by the Treasury. So at some point, one risk is regulatory, of course, is that they come out and say, hey, you can't have that. You can only have the U.S. central bank digital coin. I'm not saying that's going to happen. I'm just saying that's a potential risk. So how do we factor those type of risk into our allocations of Bitcoin and cryptocurrencies in our portfolios when we don't necessarily have control over some of those risks?
So this most immediate risk that you elucidated, I would feel confident in saying that risk is close to zero now. It was not close to zero, in recent years based on the global administrative policy towards this asset class.
Right.
But now in a very short amount of time, too many incumbent elites have profited and will continue to profit from being early on the industry. This is not any kind of conspiracy. It's just, based on information that's out there in terms of, just look at the BlackRock ETF for Bitcoin.
Sure.
It's the fastest growing ETF in history, so much AUM encapsulated in just that one company's Bitcoin ETF. And we know that there's probably 20 of them. And there's increasing financial product development. So for that specific risk, and the reason I'm belaboring this point is because this was a real risk until essentially the last 12 months. But it has been mitigated in the last 12 months. But now, if I'm going to just take your theoretical question at face value, in I think the spirit that it was intended, it's in our personal interest never to be overexposed to any type of volatility, to use your word, that we can't manage. Volatility itself is a product. So, just giving a nod to MicroStrategy, MicroStrategy is not selling widgets; they're selling volatility, and openly. This is their strategy.
Yeah,
it's not
hold that thought, because I really want to dig into that with you, because you wrote a really great piece on this. But let's, what I'm also, the regulatory risk was only one item. But say, for instance, though, we are talking about people saying, hey, look, if you want to buy cryptocurrency, it's great. What's the best way to mitigate some of the risk? Again, we had the whole FTX situation. We had Mt. Go a few years back. What is the best way, if I want to own cryptocurrency, what's the best way to own it where I can mitigate some of those risks of bankruptcy, fraud, et cetera, that can potentially happen and have happened and can potentially happen in the future? Yeah.
I'm going to give you an honest answer that you might not expect. Okay. The answer is, buy $100 worth of it. Whether you want to buy Bitcoin or something else, just buy $100. And if $100 doesn't get you going, make it 1,000. Whatever number it is that makes you take an interest in figuring out how it works. Because I personally believe that no one should invest in anything that they don't understand. So why would I, decide to take someone else's advice and just sign off 100K into this thing called cryptocurrency? Like, if I go by first principles, I'm gonna, buy a little bit of it first, learn about it. If I like what I see, if I like what I'm tasting, I'll order another dish. If I don't, or I don't have the bandwidth to it, because we all live busy lives, and this stuff is not, 1 + 1. Then you'll get to it when you get to it, right? And you'll buy in at the price that you deserve.
Right. So let me re-ask the question here. How should I go about? So again, assume I know nothing about Bitcoin or cryptocurrency in general, and you say, great, go buy some. Okay, great, I want to go buy some. What's the best way for me to go buy it and store it, house it, whatever? What do you recommend as being the best way to do that, where I can mitigate some of these potential risks, like an FTX, where people lost a lot of money, Mt. Go, where people lost a lot of money? How can I buy it and mitigate some of the risk of fraud and bankruptcy?
Okay, fair. So a practical answer to that is, based on, we're speaking to U.S. citizens here, there are a number of, regulated cryptocurrency exchanges that operate in the U.S. And I would say that, you pretty much, certainly, well, to my knowledge, you have to go to one of these places in order to exchange your U.S. dollars, digitally, obviously, into whatever cryptocurrency you choose, right? And everyone, I think, has probably heard of Coinbase. There's Gemini, there's Kraken, and there's others. It's not limited to those three. Right. But you would go to one of those places. You would set up an account. You would create a link between your bank or your Fidelity account or your account of choice, and then you transfer the money into the cryptocurrency exchange. At that point, you'll have a dollar account within that exchange. Let's say it's $10,000, and then you might decide to buy $1,000 worth of Bitcoin. That's something to keep in mind, is that you don't need to buy one Bitcoin. And I think that really messes people up a bit, because of course, if you're thinking about something you don't understand very well and it's trading for $112,000 for one Bitcoin, which is not a tangible thing, that is a huge blocker for most people. But you don't need to do that. Just like you can buy fractional shares in a company, you can decide to buy $1,000 worth of Bitcoin. Again, whatever number is right for you. Now, in this example, you would have $1,000 worth of Bitcoin in that account, and then the rest in cash. From my perspective, not giving any specific advice, I think it's okay, to just leave it like that and learn. Read about why this is important. You obviously see the price. Maybe if the price goes down and you get scared, maybe you'll sell it. If it goes up, maybe if it goes down, you'll buy more if you understand more about it. And I give you this example only to say, at some point, your $1,000 worth of Bitcoin in this example will go up. And you might start saying, I don't know if I really want to leave it all in this one place. I should hold it more securely. And at that point, I would advise that if you're holding on to something, you want to protect that something as safely as possible. And then at that point, you would withdraw it to what's called a private wallet. Again, new vernacular, so I'll stop there. But
no, that's okay, because there's a lot of talk about cold wallets, private wallets, these type of things.
Yeah.
But what happens if I lose my password? I mean, what are the risks of if I pull it off an exchange where I have access to the exchange? I can log into the exchange. If something happens, I'll lose my password. I can reset my password with the exchange, etc. I've got some security safeguards there. But once I move it off onto private holding, what's the risk potentially that I have over there that I need to make sure I mitigate? So it's great to hold this in a cold wallet or a private wallet, but how do I do that securely so that if I pass away, as an example, how do my heirs get access to those assets? What do I need to be thinking about in those terms?
Yeah, that's a great question. Thanks for steering me. So what I will say is, if you we've kind of established that you need to make the conversion on a fiat exchange. Let's call it Coinbase. Now you have the Bitcoin in that account, and you may decide that you want to move it somewhere that's not Coinbase in this example. But you don't then want to have all that responsibility on yourself. So one, you're correct in sort of explaining that it's a bearer asset. So just like if you have a $100 bill in your pocket and you lose it when you're out one night, you're not getting that back. Like no one is going to send you a password reset for that.
Happens every time I go to Vegas. Vinay, happens every time I go to Vegas.
You got to invite me. I'll be happy to pick up your 100. And so, okay, so now we know it's a bearer asset. You have to be careful. So just like holding keys in the real world, I know people in my life, including myself, who forget their keys. I have people I trust who also have a set of my keys. And those people, just based on my trust alone, I know that I feel safe, right? And I've, in the past, given my keys to people for a temporary period of time, and I've taken back those keys. So
right.
They're no longer a risk to get into my house.
Right.
Bitcoin works the same way. I mean, that would be the best way that I could explain it to people in terms of feeling safe. Some people won't give their keys to anyone except themselves, and they'll, hide their keys in 8 different places, maybe to save them from themselves, or maybe just because they like the challenge of going through a treasure hunt. You can do that with Bitcoin if you like that.
So what you're saying is I should not give the keys to my kids. Got it. Okay, completely understand that. So let's. I want to kind of. We're getting a little short on time here. I do want to touch on, some things that have happened with Bitcoin recently. We've seen this with a company called MicroStrategy. They went into using Bitcoin as a treasury model for their company, and this is a company that makes antivirus software, which they have basically that company as any software company is basically heading towards bankruptcy, but they made this transition into a treasury using Bitcoin and kind of gave new life to the company. Just saw it also recently, a company called Bakkt just basically convinced a 180-year-old kimono maker in Japan to become a Bitcoin treasury company as well. So we're seeing some of these companies start to adopt Bitcoin and using that as part of their treasury purposes. And so a lot of investors have jumped into MicroStrategy as an example as a leveraged play on Bitcoin. And leverage is fine. I was just having this conversation the other day on our normal show, which is talking about margin debt. And margin debt's very important for making markets go up. We need that leverage. That leverage, increases the value of the market. But leverage cuts the deepest when it cuts you. So when leverage reverses, the declination is much larger than a lot of investors kind of expect, and that when that leverage unwinds. And so can you kind of explain a little bit about the risk? You wrote this really great piece talking about MicroStrategy, and one of the lines in there is the how they reset their leverage. Can you explain a little bit more about how that works and what the risks for investors are? And because MicroStrategy and the underlying, like the 2x leveraged MicroStrategy ETF, have vastly underperformed Bitcoin itself.
Right. I'd be happy to give it a stab, and please redirect me if I
Sure.
go off in a different direction. But so with one, just to back up, so in 2020, as you correctly pointed out, Michael Saylor, the CEO and now chairman of MicroStrategy, who founded his firm back in the late 90s, he decided that he is in basically a dying business, right? So the business that he was running, software business, essentially would never be able to grow. It was still spurning off, adding value enough to create profit and whatever, but that's not, we know that that's not how the current market rewards that type of performance. It rewards growth. And so he said, what can I do? And so based on his personal introspection, he decided to buy Bitcoin for himself. And then he convinced his board, and he did it in a very methodical and fair way, where he gave his shareholders the opportunity to sort of bless his strategy or not. And the ones who did not were sort of informed, and shareholders are owners of the company, and they said, good luck to you. And so then he started investing the company's money in Bitcoin, right? By taking on debt. And this is how we get leverage. So if MicroStrategy, think of MicroStrategy as a closed-end fund rather than where you don't pay a basis point fee to like a mutual fund. So now he has a closed-end fund that publicly and privately to the tune of billions has put money where the mouth is of I'm going to buy Bitcoin. So if you take on debt to buy Bitcoin, then you inherently create leverage within the equity wrapper that we call MicroStrategy. Mm-hmm. And so then we get into this nomenclature called MNAV, multiple over net asset value. So MicroStrategy became famous, a couple of years ago for trading at a large multiple in excess of the net asset value of its Bitcoin. And that's a fair way to value the company, because essentially when you look at all the assets of the company, they're essentially zero except for the Bitcoin holdings. And again, this is the strategy of the company, is to be a Bitcoin holding company. So I'm going to stop there, because that does not mean that this is the right strategy for you, company XYZ out there. And I guarantee you that the treasury DAC strategy for Bitcoin is definitely over. You're not going to add value to your company by putting Bitcoin on your balance sheet unless you have a meaningful way to put that Bitcoin, i.e. capital, at work. Mm-hmm. No different than any other business. You got to put it to work. So there is a very innovative financial product company out there that sells life insurance that's denominated in Bitcoin. And if you are someone that is interested in taking out a whole life insurance product, you are going to be very well placed to take advantage of that policy, even if you have a fiat mindset. So there's lots of very interesting things at play here if you take the time to investigate it, which I know that you are. Mm-hmm. And now to put a bow in it, the MicroStrategy product is actually no longer a levered play on Bitcoin. It was, let's say, 2 years ago. Mm-hmm. Now the target market for MicroStrategy is a convertible arbitrator, right? Someone that is maybe from the bond world that is on the risky side of the bond world, who now has access to equity level returns while playing in a bond world.
So, but yeah, I want to finish up this conversation because, again, in your article, you talk a little bit about the 2x leverage MicroStrategy ETF that's out there. And again, we're seeing a lot of these derivatives. I was talking about leverage earlier. We like, for instance, MSTX and NMSTU were both leverage plays on MicroStrategy at 2x, right? Those are just 2x leverage ETFs. Now we're up to 5x leveraged ETFs on cryptocurrency. And again, leverage is fine on the way up. It really cuts you deeply on the way down. And the investors were gambling a lot on the MicroStrategy 2x levered ETF, and there's a big gap in performance between that leveraged ETF and just MicroStrategy. And why is that? What's happening inside of that? And this is the thing I want you to explain, is how that leverage works with MicroStrategy and why it's creating such underperformance.
So I think with MicroStrategy itself, MSTR, I would say there is no underperformance over, like, let's say a 5-year time frame, 3-year, 2-year. I don't even think over a 1-year time frame there's underperformance in that. But for the levered ETFs, 100%. You can look at the graphs and you can see what but what's basically volatility decay. And the way to think about that is if MicroStrategy, goes down 20% in a day, then the 2x levered ETF on MicroStrategy is going to go down 40% in a day. Let's round down to it's now worth 50% of its value from yesterday. Now it has to increase 100% in order to get back to where it was yesterday, right? Just the way the math works. So that's to your point of when you say it really cuts on the downside, it does. So those products, again, like I would, this, nothing that any of us are saying is financial advice here, certainly not mine, but I would encourage people to, be very wary, unless you're a professional kind of investor that is looking to hedge something. Stay away from those, levered ETFs because of what you said.
Let me just read to you from your own article because I think it sums it up best. These investors, gamblers seeking this product are not satisfied with Bitcoin's volatility nor that of MicroStrategy. They want more. The catch is in the daily part. MicroStrategy resets its leverage every day. MSTX, the ETF, resets its leverage every day. So it's not 2x over a year, it's 2x over each day's move, compounded. And again, that goes back to your point. If it's down 40, if MSTR, the company's down 20% in a day, that's going to be down 40. They then reset that leverage, and you have this decay of premium in the underlying options that make it even more difficult to capture it back to where it was the day before. And that decay of premium and that decay of time in those options continues to compound over time, really reducing the performance of that. And you see it in the charts. It's not been a profitable investment for people that were buying that near the peak a couple of years ago when they first came out with that ETF. It's not been a good investment. And it certainly hasn't tracked just owning Bitcoin. You were much better off just buying Bitcoin and not trying to chase MicroStrategy.
100%. Yeah, these products are not buy and hold investments. If you are, again, a professional, then no professional is in these kind of tickers for more than a couple of days at a time.
Mm-hmm. So Vinay, good conversation. Want to kind of wrap it up here. What did we not talk about today that you think is important for individuals to know about Bitcoin, cryptocurrency itself, investing in it, holding it, whatever? It doesn't matter. What was did we miss any important points that they need to understand?
So I think we covered so much ground. Thank you so much for such a provocative and thoughtful questions. I'm definitely glad I had my coffee this morning to be somewhat prepared.
Are you drinking orange peel coffee or?
I am, of course. living the brand. I'm not limited to that because I need to explore, but yes, I am today. So what I'd like to share, which I think I could wrap this up in any number of ways, but hopefully as like a trailing provocation, is we talked a lot about Bitcoin, we talked a little bit about gold, we talked about US dollars. Now, you may not be there right now, audience, but we can, I think, agree that US dollar is money. We can agree that gold, if not today, in centuries upon centuries, has been used as money, not only as something to store in Fort Knox, but also, in the old days, you pay with a gold coin. So that's money. And then the advocates of Bitcoin consider Bitcoin to be money. So let's agree on that for this last provocation. And now, instead of thinking that everything is denominated in US dollars, for the purpose of this, think that everything is denominated in gold. Okay. Mm-hmm. And we start the clock in 1971, and gold and US dollar are on the same index line, 100 of 100. Over time, gold has gone up, right? It has gone from that 100 index line all the way up to 40, right? Because it's $4,000 now. And whereas the US dollar line is pretty close to basically still 100, because it's only worth $35 compared to the 4,000. Now, add to that graph in the year 2010 Bitcoin. So now you have, from 2010 onwards, you have 3 lines. And if you want, just start at 2010. Now, this is how you compare money. Gold, you'll find, is in relation to the others is quite at parity. The US dollar depreciates against gold, and Bitcoin appreciates against gold. So gold is in the middle, flat. Bitcoin appreciates against gold, dollar depreciates against gold. And just sit with it, think about it. Think about what that means for you, for your portfolio allocation, and I'll leave you with that.
No, and that's a great point. As I said earlier, this is the important lesson to take away, is that everybody should understand that you cannot just hold cash. Now, a lot of people, I see a lot of mistakes that people make as they have cash in a bank account right now, and they're like, oh, I've got to get this invested in something, and because it's just sitting there, it's not earning me any money, and I'm losing value today. That's not true. You don't have to invest today. You're not losing a bunch of money today. The dollar today will buy the same amount of goods tomorrow, right? Now, over a long period of time, to Vinay's point, it will purchase less because of inflation. So this is why it's important. We have to invest it. We have to invest it somewhere. We invest it in stocks, bonds, gold. We can invest it in Bitcoin. It doesn't matter. But we do have to invest, and we have to invest in assets that will appreciate at a rate greater than inflation over time. That's the whole thesis of why we invest, is to protect our future purchasing power of our savings. And so we can't just sit around with money in a coffee can. That's not going to work. But again, we also have to measure and monitor the risk of the investments that we're also investing in, so that, again, if you're 65, you can't suffer a 50% drawdown in the markets because you just simply don't have the time to recoup that by the time that you need the capital for retirement. If you're 30, 50% drawdown may be a great buying opportunity. But those are the things that we have to think about as investors. But today, it's a very valid point that you make, and something that is so important that we get investors to understand, is that they do have to get money invested somewhere, and they just need to get it out of cash and into something that's growing at a rate of inflation or better.
Totally agree.
Yeah.
Well said.
Thank you, Vinay, so much for joining us today. And that concludes our interview today on The Real Investment Show. Lots of great interviews coming up. Our next guest will be Thomas Thornton as well. Great hedge fund manager. He'll be a lot of fun to talk to about markets and risk in the markets that we're currently taking right now. That'll be coming up here very soon. Also, be sure to get by the website, realinvestmentadvice.com, download our latest articles, and of course, don't miss liking and subscribe to this channel. We really need your help to keep our channel growing. Like and subscribe to the channel today, and we'll see you back here on tomorrow's edition of The Real Investment Show.